One of my favorite bands in high school was Rush, and they have a great song on the Presto album called Show Me, Don't Tell Me. Now, in the on-demand class, I threw a lot of numbers out there. Stuff like the wholesale income advantage will get you 53.1% more in retirement. Now, that makes a good soundbite, but what does it really mean? In the spirit of show me, don't tell me, now I'm going to show you exactly how I came up with those numbers. Most importantly, I'll also walk you through exactly how you can check my work and how you can verify it for yourself. Like Ronald Reagan's famous phrase when he was talking about the Russians, trust but verify. I want you to verify my work. So let's get started. First, here's the big picture. We're going to look at your typical Wall Street advice to put your money in a balanced portfolio of 60% stocks and 40% bonds, and use a reasonable withdrawal rate, typically 3 to 4%, to support yourself in retirement. I'm sure you've heard this advice because it's all over the mainstream media. But what I'm going to show you now is just how disastrous this advice can be, and how you can do a whole lot better in the long run and do so with a whole lot less risk. So let's take a second to highlight 3 major risks that this terrible advice saddles you with, so I can show you how the wholesale income helps you mitigate those risks. It's really important to understand what you're up against. First, I'm sure you've all heard of dollar cost averaging. That's when you buy into stocks on a regular basis and build up over time. When investing for your future, dollar cost averaging makes good sense. You're investing your money for use way off in the future. All those frequent ups and downs in the growth part of your portfolio don't matter as much because you're not using the money right now. You'll use it in the future. In fact, when you're regularly putting more money into the market, those market downturns actually help you, because when the market tanks, shares are cheaper and you end up buying more with your regular purchases. So over time, you're very likely to end up with more shares and end up with more assets in the end. But when the tables turn into retirement and you're living off of your invested assets, there is a reverse dollar cost averaging effect at work. Some call it dollar cost ravaging. And it really makes sense when you think about it. Instead of putting money in on a regular basis, now you're taking it out on a regular basis. You're selling off your holdings regularly to buy groceries, and the market may be up or it may be down when you need the cash. Timing is everything. And when reverse dollar cost averaging, systematic withdrawals often deplete a portfolio much faster. When you have to sell in a down market to buy groceries, not only do you realize the loss when selling, but your portfolio is now smaller. So when the market rebounds, you have less invested and you can't recover. Once you sell your holdings and spend those dollars, they're gone. This reverse dollar cost averaging can really hurt. And it's the position that many people put themselves into when they blindly follow the mainstream Wall Street advice to buy stocks and bonds and use a 4% withdrawal rate. They run straight into these major retirement risks. Now, we just talked about reverse dollar cost averaging, but this bad advice leaves people with more risks. There's also sequence of return risk. And this one's a doozy because it compounds other risks. If you're in the markets and you're depending on those assets for retirement income, when the bad years fall in your retirement can have a dramatic effect on the longevity of your portfolio. Risk is highest in the early years of your portfolio. An economist named Moshe Milevsky did a study looking at a portfolio with a 7% average return and pulling out the same amount every year using this table. Each row in the table averages 7%, but some rows have strong early gains and some have early losses. The dark blue line is what happens if you have strong early gains in the portfolio. The money lasts over 30 years, even taking withdrawals. But the yellow line has losses in the early years and only lasts 14 years with the same withdrawal rate. Now, both portfolios have the exact same withdrawal rate and they have the same average rate of return. The only difference is the market. When the bad years come early, portfolios fail way faster because they don't have time to recover. So what's the lesson here? Average returns mean nothing, and timing is everything. When the risk is that you're running out of money in retirement, I have to ask, why carry that risk? This sequence of returns risk can be insured around. In fact, Mitigating these risks is exactly what the wholesale income advantage does, and it can make a huge difference, just like you saw in the on-demand class. So I've got a question for you. What if you could maintain your income without having to sell when the market was down? What if you always knew without a shadow of a doubt that you would have enough money in retirement? And what if you never had to worry about reverse dollar cost averaging or the sequence of returns risk? Or this third big risk, the withdrawal rate risk. So if these questions resonate with you, and if you want to avoid some of these risks, well, chances are good that you've already looked into annuities. Now, I got to be perfectly clear. I am not an annuity salesman, but this is the fundamental starting point for a lot of annuity sales pitches. Your typical broker will lay on the fear factor with phrases like, do you have enough? Or he'll needle you with questions like, will you have to work as a Walmart greeter in retirement? Will your money last as long as you do? And then they'll offer the sweet relief with sales phrases like, what if I could wave a magic wand and guarantee that you would never ever run out of income? Would you like that? You've probably seen charts like this for index annuities or sales presentations, or heard phrases like, you can go up, but you can never go down. Well, hopefully you're smart enough to have done a bunch of research online and also seen some of my friend Stan's videos, because he shoots straight. And I agree with him that too many annuities are sold on fear by these sales guys just shilling products. What annuities do is help mitigate this third big risk that I wanted to talk about, the withdrawal rate risk. But they do it at a huge cost, and they're not really the right tool for the job. Most people are pretty familiar with the traditional 4% withdrawal rate, sometimes known as the prudent man's rule. Exceed that, take too much money out of your portfolio, and it goes to zero, like the red line here. So is this 4% withdrawal rate rule still valid? It kind of depends on you, your age, your timeline. In your traditional 60-40 stock bond portfolio allocation, the safe withdrawal rate is somewhere between 3.2 and 5.2% based on your age, according to a recent Morningstar report from last year shown in the red box here. Bottom line, your portfolio will go up and it'll go down. Your mileage will vary with withdrawal rates that you choose. But by now it should be pretty obvious that reverse dollar cost averaging, sequence of return risk, and withdrawal rate risk, these three go hand in hand and they magnify each other. And these are all risks that you carry when you're following the mainstream Wall Street cookie cutter advice of a 60-40 stock bond portfolio with a 4% withdrawal rate. So no more hiding from reality. We talked about the problems. It's time to look at solutions. And that's where the wholesale income comes in, especially when you use these innovative payment streams the way I showed you in the on-demand class. Using wholesale income streams for retirement, you eliminate these three major risks completely. And you may even end up with more assets overall. So why are wholesale income payments better? It's really simple. A higher yield means a lower price. You get more income and more safety and more yield for your money with wholesale income than you do with any other type of safe money investment. Now, I've been working with these wholesale income contracts for 12 years. I've personally handled over $250 million worth of these payments. And no individual, advisor, or institutional client of mine has ever lost a penny. It's an incredible little corner of the larger financial landscape that practically no one knows about because large investment banks and securitization firms like J.G. Wentworth, well, they gobble it all up. There are many pages on this website about these deals and how they came to be and my role in the industry, but I'm not going to bore you with that right now. Over the 12 years that I've been in the industry, we've been in a prolonged falling interest rate environment. When I started in 2011, we were occasionally able to offer contracts in the 6% yield range. By 2022, that had fallen to the mid 3% range, as assets around the globe had fallen in yield. Just when I thought things would level out, COVID hit, and we had another wave of stimulus money and low rates. Frankly, it was a really tough time for savers and investors. But in the spring of 2022, it all started to change. Rates shot up from the 2% range to an October high of 5% in the 10-year Treasury. They've come down a bit today, but we're still up dramatically from where we were just a couple of years ago. In fact, this is one of the fastest increases in rates in the history of the United States. Take a look at this chart of the US 10-year Treasury. What you see here is this steep increase in rates coming in the last 2 years. You can see that it has topped and is coming off of its recent highs, but it's still significantly higher than it has been for a long time. What does that mean to you? Higher yields equal lower prices on fixed income. When yields go up, the cost of wholesale income contracts go down. And when you have really high yields like we do today, you can use guaranteed income to shake up a portfolio and make dramatic long-term improvements. This is the shocking discovery that my good friend Paul made, and he used it right away with one of his clients. He set his client up for long-term success by buying a portfolio of wholesale income contracts. Now, we talked about his success, and it's now what we call the wholesale income advantage. Like any good idea, at its core, the wholesale income advantage is really simple. You use enough of your portfolio to buy guaranteed payment streams for the income that you need, and then you put the balance of your portfolio into a growth vehicle, and you guessed it, just let it grow. You get your guaranteed income at the lowest possible cost at wholesale prices, and you let your growth assets do what they do best. You let them grow without having to be tapped for income. You get more money, more safety, and ultimately more flexibility and options than a 60-40 Wall Street cookie cutter stock and bond kind of allocation will ever give you, or an index annuity approach, as your index annuity salesman would tell you. You eliminate all three major risks that we just talked about, and it just plain works every single time. It works because our long-term yields on income streams are so much higher than they were just 2 years ago. We can beat the pants off a typical 60-40 stock bond allocation over long-term historical time frames. As you saw in the on-demand class, the results are stunning. And now I'm going to show you exactly how to get those results yourself. I want you to test them, prove for yourself, and then reap the rewards. And I've also got a disclaimer here. Let me be clear. I am not a money manager. I am not advising you to buy a stock or a bond or make any specific asset allocation in equities markets. I'm going to refer to the stock and the bond market in a general sense because, well, that's what you hear all over the media. Typical 60-40 stock bond allocation and a 4% withdrawal rate. It's a thoroughly beaten and a long dead horse. But as part of this educational presentation, I'll reference a few really low-cost Vanguard index funds with super low fees that are well known and easy to use. And they're easy to backtest. But again, I am not in the stock picking business, and I'm not giving you investment advice. Your mileage will vary when you select different funds in the free illustration tools that I'm about to show you. My purpose here is just to show you how I came up with the numbers, give you a calculator tool to do it yourself, so that you can test it, and like I said, trust but verify. I want anybody who's considering this strategy to know exactly what they're getting into and to have come to their own conclusion. So let's go over to the computer, and I'm going to show you exactly what I'm talking about. All right, so what we're going to do is take a typical portfolio. I'll use an assumption of $1 million portfolio. Your mileage will vary. You may have more, you may have less. Just call me and we'll work out we'll work on your specific situation. But we'll take a typical portfolio, and what I'm going to do is put it into a couple of analysis tools that are freely available on the web so that you can look at what this cookie cutter Wall Street 60-40 stock bond allocation will do over the course of time versus the wholesale income advantage. I'm going to pick an actual case from our inventory right now, and then we'll just look at those things on apples to apples basis. And you can see exactly what I'm talking about. What we're going to do is look at a typical portfolio and compare the results. So I put together this calculator for you. It's freely available for download on this page. So we're going to look at a typical 60-40 Wall Street portfolio, and we're going to compare the results using a real case from inventory. Now, if you have $1 million portfolio and you're following this advice, you might take out $40,000 or $41,000 a year, and you want that to rise over the course of time with inflation. So looking at inventory on our website, which is on wholesaleincome.com, there's a wide range of available cases. Some are small, some are large, some are short, some are long. There's a variety of different payment streams. All of these are guaranteed period certain income streams, but this one in particular jumps out as being particularly well suited for this example. So I'm going to take this Berkshire Hathaway 26-year income stream. It starts at $3,350 a month. It goes up 3% per year. And you can look at the case, you can look at the specific payment stream right here. and see that it increases 3% a year, starting out with the first 10 payments, $33.50, and then it goes up every year 3%, and so on through the life of the payment stream. So let's go ahead and copy this one, and we're going to just stick it over here for easier reference. So this pays out, let's assume you're starting with $1 million portfolio and monthly withdrawals of $3,350. We're going to make an apples to apples comparison of 60-40 Wall Street advice versus this particular case in the wholesale income advantage. So if you were following Wall Street's advice and you had $1 million and you wanted to pull out $40,200 a year for 25 years, what would it look like? So to do that, I'm going to use a couple of tools. Vanguard produces lovely index funds that are very low cost, cheap, and easy to use. Freely available. You can do your research on them. I've pointed out a couple of them here. Stock ETFs and bond ETFs. Again, I'm not a stock or a bond advisor. I don't advise you to buy or sell any of this stuff. I'm just using it for illustration purposes. But we'll use the VFINX and the VBTIX, the bond fund and the stock fund. This just looks at bonds in general, and this thing tracks the S&P 500. So they're good proxies for the market. So what we're going to do is go to this free portfoliovisualizer.com tool and look at a Monte Carlo simulation, which looks at actual historical results over the course of time. So we're going to start with this same assumption of $1 million portfolio, and we're going to take out an amount periodically of $40,200 a year. $40,200 a year, adjusting for inflation annually. We're going to run this for 25 years, and we are going to use 3% inflation because this payment stream goes up by 3%. So we're just going to level the playing field here with 3% increase in the payouts, 3% increase in the withdrawal, and look at how this plays out. So we're going to put VFINX here for 60% in the stock market and VBTIX for 40% in the bond market. And we're going to see what happens over a Monte Carlo simulation. It would help if I could type right. VFINX. VFINX. And VBTIX. And then we're going to look at these 60-40 stock bond allocation and just run the simulation. What happens when you're withdrawing $40,000 a year, increasing for inflation over 25 years? What are you left with? Well, in the lowest percentile, you're left with $250,000. In the best case scenario, you've got $6.4 million. Let's just pick the middle of the road here, $2.3 million. If you look at the $2.3 million value, we'll bring it back to this little calculator. So your ending portfolio value is $2,360,000. So you've lived for 25 years on an increasing monthly withdrawal rate of 4% following following the mainstream Wall Street advice. And if you're in the middle of the road, you got $2.5 million or $2.3 million left over. Pretty good, not too shabby at all. What happens though if you look at the wholesale income as a different way of going about this? Instead of having stocks and bonds, you buy this guaranteed income stream to give you that $40,000 a year, and you invest the difference in the market, and you let it grow, and you're not taking any withdrawals off of it. This contract costs $700,973. You're left with $299,027 left over. So we're just going to go back over to this simulation, and instead of a 60-40, we're 100% stocks, and we have no withdrawals. okay? And we don't have $1 million to start with. We've only got $299 to start with. What's going to happen? You've got your income taken care of. You got your safe portion of your portfolio totally taken care of with a Berkshire Hathaway guaranteed payment stream for 25 years. Well, what are you left with? Worst case scenario, 1.3. Best case scenario, 10.5. Same middle of the road, $4,067,000. Let's come back over here and just put it in here. Last time I checked, 4 million in the 50th percentile is more than 2.3 million in the 50th percentile. In fact, it's 72.27% more. These are the numbers we did in the wholesale income, in the on-demand class, illustrating the power of wholesale income. And 72.27% more assets in retirement over a 25-year lifespan with more safety and higher yield. It's just, like every time I do this, I'm shocked at how it works. It works every single time. And it works because we have these high interest rates right now. And so the yield on our wholesale income contracts exceeds the historical anticipated yield of a bond portfolio. Going back over years and decades of history, that's what this Monte Carlo simulation tool does. It goes back over all history to look at what the effects of the up and downs of this bond market would be when you're taking money out of it, running the risk of systematic withdrawals and market timing and all those other risks. And when you're carrying all that risk, you have a wide range of possible results and a high chance of failure and lower overall output. Take all those risks off the table, put it into a wholesale income contract like this Berkshire Hathaway, and it's basically like buy term and invest the difference. When you're thinking about life insurance, I'm saying buy a term income stream and invest the difference for growth. You have a much better safe versus growth risk parameter. In fact, looking at this, some would say, oh, you're 70% in fixed income and 30% in the market. Well, okay, fine. You're 70-30 safe versus risk, and you end up way better off than if you're 60% risk and 40% safe in the typical Wall Street 60-40 methodology. We just do better because it costs less, yields more, and you win in the long run. So I hope this illustration has helped. These tools are freely available. There's downloads below this video for this specific calculator. You can see our current inventory. You can pick different stock and bond funds. You do, as I said, I'm not a stock and a bond analyst, so I'm not telling you to buy one thing or another. I'm just trying to compare this to what you're going to see in the mainstream media. But you do your own math and give me a call if you want to look at specific cases. You may not have $1 million. You might have more. You may have less. You may not have this amount of income that you need. But the fundamental logic here just makes sense every single time. So I hope this presentation's been helpful for you. If you have any questions, please don't hesitate to give me a call. Thanks.